Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome to the show. Thanks for tuning in. Phil Tarrant here, editor of Smart Property Investment. Joined today by Alex Whitlock. Alex was my business partner and I invest with him in property. So I thought I'd invite him into the show to add some brilliant guidance and insights.
Steady on there, Phil. Steady on.
Thanks for coming in, mate.
Thank you very much.
It. And we've got in Lisa Montgomery into the show. Lisa's a good friend of Momentum Media, has been for a long time.
Many years.
So thanks for joining us, Lisa.
Thank you. Thanks for having me.
It's good. You might also know Lisa. She's on Sky quite a lot on Your Money, Your Call.
Mm-hmm. Sky Business Channel.
Sky Business Channel number, I can't remember what it is.
602 on the dial.
There we go. Give him a free plug. But Lisa's got an interesting background, and my relationship, or our relationship, mine and Alex's, with Lisa has been very much around mortgages. So we thought it was a really good opportunity to get her onto the show and really pick her brain around mortgages and what they do and what they mean. I think most people have a negative perception towards mortgages. It's an unnecessary evil. I don't particularly see it that way. Alex, you don't really see it that way.
No, we've done very well with using finance in a smart way and leveraging off that. So I think Lisa can shed some light on how she sees that as well.
Yeah, so I really wanted the topic of today to be how a mortgage is a tool for wealth creation. So why do I invest in property? Why do we invest in property? It's a number of different reasons, but primarily it's a wealth creation tool. So
that's right.
We buy property on the basis that it will go up in value, and it's hopefully not going to cost us too much to hold that. In order to do that, we need a mortgage, and our appetite towards finance varies depending on how we're sitting with our portfolio at any point in time. When we kicked off, we were happy to finance at 90s. It's a different time, as 5 years ago. It's 90% LVR. Today, our portfolio sits around about 65%. So there's quite a lot of fat in our portfolio, and we're gearing up to buy again. And obviously, we're going to need a mortgage to do that. So for us, a mortgage has given us leverage to build quite a sizable property portfolio. But my discussions, what we write about a lot on smartpropertyinvestment.com.au, is around mortgages and a lot of the negativity towards it, or people don't understand what it is and how it works and why you have one. So my first question to you, Lisa, is do you think your average Australian investor understands what a mortgage can actually do for them?
Wow, that's a big question.
It is.
Look, I think savvy and seasoned property investors understand it because they use it as a tool, and they understand the machinations of the product that allow them to not only buy the property that they might be interested in right now, but also to build that portfolio that they may be looking to build, and how maybe that product is going to help them leverage into the next and the next property. So I think savvy investors do understand that, but I think the average guy out there in the street, mortgages have been seen as quite a negative force in the world. It's the largest debt most people have. It's a very large commitment usually for the owner-occupier family home. So it's kind of seen as for some people as like that ball and chain around the ankle, because it's one of those things that sort of makes you have to go to work every day to pay it off. But mortgages are much more than that. And it's interesting whenever I'm asked this question, I talk about the fact that the very first deposit you put down on a property is that entity that becomes your retirement strategy. That deposit is the first step toward retirement, because it's equity is going to grow from there. And from equity comes opportunity. And so when you're making that deposit, you're taking out that loan, the one thing you want to do is get more equity. And the way to do that is to pay down that mortgage, obviously, accelerate those payments. But the other thing you want to do is have natural capital gain on the property or the investment that you're purchasing. So then what that does is allow you to access that equity to leverage into other things like might be another asset class, or it might be the thing that we love and we desire, which is property, because it's tangible, we understand it. So I think, to answer your question, I think that over time, and probably in the last 15 years, I think people have become a lot more used to understanding the virtues of mortgages, and pretty much if you peel them all back, there's only probably about six 6 to 10 products out there, but they're all dressed up in different clothes when it comes to the marketing and when it comes to how they're positioned in the marketplace. But the fundamentals are really the same, with a couple of add-ons. And so I think over time, I think people have become a lot more used to using it and using calculators and tools to see how they can achieve by using that product.
Lisa, can I just ask you a question? I know you spent, now correct me if I'm wrong, close to 20 years working at the Newcastle Permanent, is that right?
Yeah, that's right.
Early days.
Yeah.
In terms of mortgages, do you think that there is a lot of variety? You said the basically six to eight products that are dressed up in different clothing, but how important do you think it is on that basis to choose your provider? In Australia, we've got major banks, 4 of them. We've got some regional banks and some foreign banks. We've also got some non-banks. How important do you think it is to look at who actually lends you the money?
It's interesting. When I look at a mortgage product, I think it's very important because you really want to partner with somebody who's going to share and take that journey with you, particularly if you're an investor.
Yeah.
And it may not be just one institution. It may be a number of institutions, depending on what your strategy is for short, medium and long term. And so, because it's interesting, when you look at a mortgage product, it's made up of 5 components for me.
Yep.
One is interest rate, obviously the most important. The other one's fees, which is, your ongoing fees and your and the fees to actually get into the mortgage.
Yep.
The other thing is flexibility. So things like being able to move it and shape it depending on how what detours you take and what you might be wanting to do. So, for example, you might want to borrow more money and you might want to do it really quickly. You want that to have that flexibility. The features of the product. So, does it have things like the ability to make extra payments? Does it have offset account attached to it? All of those things.
Yeah.
But the most important thing, particularly from an investor perspective, is to have somebody who's providing you with the product that understands how it works and how you can make it work. Because sometimes we don't have that information. And if we don't have that information, that can be like gold. You can have the lowest interest rate in the marketplace, but if you don't know how to use the product, it's not going to do you as good as what you need it to.
I think you're trying a very interesting point there, because interest rate is so apparent. It's it's there in front of you. You can see the rate, and we all know that rates change over time. But you're buying it at any one particular point. Flexibility is such a critical thing, and how, particularly first-time investors, how can they understand the value of flexibility and how can they identify that at the front end when they're taking out a mortgage?
Yeah, I think you've got to know what you're looking for. And if I can say, there's a lot of great comparison sites out there that will help you understand what the moving parts of a mortgage are.
Yeah.
And if you look at that in context with what you're looking to do, and also get the advice of a lending professional, it's going to be easy to make that decision. There is a lot of products on the market now that don't provide you with that, shall we say, one-on-one support.
Yeah.
And they sit in the online mortgage space. And often they're the cheapest rates in the marketplace because, you don't have that I guess.
No frills, I guess.
No frills.
Yep.
You're getting a low rate, but you don't really get that, one-on-one support or somebody to take that journey with you, that expert support. And so they sit there in the marketplace. The other thing that's sort of part of the, really observing what the true cost of a loan is the comparison rate. And that's going to show you the true cost of the loan, which will include fees that you can actually determine will need to be paid. Not those that possibly will be paid, like redraw and things like that, but things that are going to be paid. And it's really, really important to look at the annual percentage rate in context with the comparison rate so that you know what the true cost of the loan is going to be. If the annual percentage rate might be really low, but there might be fees built into the back end of that product, or indeed there could be like an interest rate increase if it's a fixed loan, where it's actually going to a higher than normal or higher than you would want variable rate after it comes off fixed, which we can also talk about if you want to.
Yeah, I think we would at some point. On a daily basis, I work with mortgages, and even I often get confused about all the features and benefits and different terminology like variable rates, comparison rates, and all this sort of stuff. And I know a lot of our listeners, the mind boggles sometimes, going back to our original point that for a lot of people it's a necessary evil and there's all these terms and jargons, and how can Do you think that people need to be more educated about mortgages? And the answer is yes. But how can they do that? How can they actually go and understand all these features and benefits and how they can use them as to help them achieve their goals? Because the more features you have, you pay a bigger premium on the interest rate. So a lot of the times people don't need all this stuff, but how can you establish what you actually need?
Yeah, it's interesting. I think you really do need to have expert advice. I think that's one component. I think it's important just to say, though, that, I've been involved in consumer advocacy over the last 15 years in providing a lot of information to consumers via the media. And, since, the year 2000, it's been one of those things that's really been embraced by press. So there's a lot of talk about mortgage products, what they do, how to use them. So there's plenty of reading that you can do. There's wonderful magazines that you can read, which will help you to understand exactly what the virtues are of mortgage products and how to use them. And it can be kind of a bit of a revelation. But I think that really what's happened is the media have really helped consumers understand these products a lot more over time. So I think, you do need some expert advice from somebody who understands. And
where can you get that advice?
Yeah.
And is this... having taken mortgages out over the years, I've used brokers and I've been to banks, and I have had some fantastic bank branch managers who've given me wonderful advice. Now, they're only obviously providing their own product, but they really know their stuff inside out. I've had some dreadful bank managers, and I've had some great brokers, and I've had some less, effective brokers. Where can borrowers get good advice?
Normally, the best research you can do is the research you do yourself. There's an aspect of that. So you need to go and do some homework before you actually go and talk to someone.
So have an outline of what you think is going to suit.
Have an idea.
Okay.
Yeah, get a bit of an idea. Have an opinion.
Yeah.
Then look, there are some good brokers, people who have perhaps not been in the business for very long as well. Normally word of mouth is going to help you to understand that. And people talk, barbecue conversation, water cooler conversation. You'll hear that there'll be people who have been in the business for a while and they know their stuff. You can, make a call, talk to someone before you actually meet them. You can have a set of questions that you're going to be asking them. How many investors do you actually work with? Are they building property portfolios? Are you willing to help me?
So find an expert in your particular area that you want to borrow. Okay.
That's right. And then if you can do that, because we need to surround ourselves with people in accountancy.
Yeah.
We need to have good quality lawyers that are looking after our interests from a legal perspective, and we need somebody to help us know how to use the product. And that is going to a broker is a fantastic option to do that, because they do understand the scope of product out there, and that's where some brokers don't have all of the products.
Yeah.
But it's a good thing for you to then go and do your research and know what's out there.
It's interesting you say that, because I saw my first experience with a mortgage ever was with a broker. I won't sort of get too bogged down, but I was living in Hong Kong. I couldn't get a loan from the Australian banks. I was having a nightmare. A broker flew out from Perth, said, Alex, it's going to be perfectly okay, got me sorted out. I was very, very happy. So I'm a big advocate of brokers. I did, however, and I won't go into any sort of names, but a little bit later on, I got a couple of properties that needed refinancing. I was going to take out another loan. This was probably about 15 years ago. And a broker came along and saw me. However, when I sort of sat and chatted to the broker, I got an inkling that they didn't really understand investment. And I asked the broker, first of all, if they were an investor themselves, and they weren't. And the guy ended up not coming back to me, which was very disappointing. But I think it's worth identifying whether it's a broker, whether it's a bank, that they actually understand investment and they understand how it works.
Absolutely.
So running on that theme, we keep calling a mortgage a product. It's a product that does a thing. You buy, and as we said earlier, there's not that much difference between mortgage products. I'm an investor, and I look at the lenders that I use, and we have major banks, some second-tier banks, and also some non-banks. I'm quite familiar with all those different types of terms. But if I'm an investor and I'm using a mortgage broker, and the broker says, I've got this loan over here, it's with the Commonwealth Bank, and then I have this loan over here, which is from Phil Tarrant Lending. Mm-hmm. It's the same thing. The natural inclination of investors is go, I know the Commonwealth Bank, they're safe and stable. Who's Phil Tarrant Home Loans? how can an investor really look at, these white label or no name type or non-banks versus the major banks, and does it really matter that much? Is it the same thing?
Yeah, look, it is. And I was in the non-bank sector for many years, and it was always a struggle that we had to compete against the major financial institutions because people would go with a name brand. I mean, I guess, if you look Louis Vuitton versus, something from a major department store, it's kind of that kind of approach that some customers take. And, as I said at the beginning, the mortgage product itself has the same fundamentals, but the service aspect, it's who's actually selling you the product and giving you the service that's actually going to see you get some success, because there are decisions that you have to make in relation to, for example, I've had some investors come to me and say, look, the NAB, I've got 8 properties, they're all financed through the NAB. The NAB's sort of saying to me now, I don't want to finance you anymore. Yeah. So you have to have someone that's going to anticipate that. And that's why a lot of investors will spread amongst 1, 2 or 3 lenders. So they're actually getting a little bit exposure, and they've got some leverage with each financial institution that they have. I mean, the other thing too is the fact that a lot of people are told that they need to cross-collateralise their properties and have everything with one lender. But then, that has a tricky nature to it, because unwinding such an arrangement which is so bound is sometimes very difficult to do. So there's all of these sorts of things and more that this person who's providing the service has to give you a piece of guidance and advice on.
So in terms of the leverage with lenders and and serviceability, we've got banks and non-banks, and we have one of our loans with a non-bank called Pepper. And absolutely brilliant. I don't mind giving them a plug.
Me neither.
I picked up the phone. I speak directly to someone that knows everything about me, and I think it's absolutely great. But because I have a portfolio that has multiple lenders, our broker just recently repriced the whole lot, brought our interest rates right down, and all that was that someone within their office dealing with all lenders, and one in particular saying, these rates aren't competitive enough, you better do something about it, otherwise you're going to lose this person. And they repriced the whole lot. And it's probably saved us over $1,000 a month just in a slight reduction in interest rates.
Just to carry on from what you're saying there, Phil, brings sort of an interesting point here with price versus service. And I'd like your opinion on this, Lisa, because obviously we're all very price conscious. You and I share a portfolio, and we don't want to see any more money going out on servicing our loans than we have to. However, how, Lisa, do you evaluate in this scenario where you maybe refinance a loan to a lower rate versus the service that you're getting from your lender?
Well, you need to analyse what it is that that's the pain point for you with that arrangement. Yep. Is it the service? Is it the fees? Is it the features or the flexibility? Or is it the interest rate?
Yeah.
And if it's just the interest rate, then it's very, very easy now. I mean, I made a call myself only just a few weeks ago and knocked 0.5% off my interest rate. And just to talk to that further, anybody who's got a portfolio or have had their loans for any lengthy period of time will find that there's potential there that their rate has slipped out of the competitive band. And because we work on a set and forget mentality, most of us in this world, because it's very easy to set and forget. Yep. Everything comes in electronically, everything goes out electronically. We take our eye off the ball. And so it's a really excellent exercise, which will take you less than an hour, to go back and take a look at your interest rate. And then and check it out on some of these wonderful comparison sites that you can get to see if you have slipped out of the band. Now they're expecting your call at the bank or at the lender. They're expecting that call, because it's much cheaper for them to keep you and give you the reduction than it is for them to lose you and go and market and find another customer.
But what do you say though? So just say I'm the bank and you're Mrs. Investor.
Yes.
You call me up and say, my rate's not competitive?
First thing I do is I do my homework. So I take a look to see what is competitive in the marketplace. The second thing I do is I go onto their website, because I can absolutely guarantee you for new customers, they're offering them a fantastic whiz-bang deal that you're not getting. So if that's the case, then you need to know what that rate is, and you need to know what your rate is, and there's going to be a difference in that. So you really want to aim for what they're offering new customers, or even less than that. Because if, depending on what the competitive band is and where look, we've got lots of variable rates, lots of fixed rates there now under the 4% mark from a variety of lenders, and they're all jockeying at the moment because there's a lot of business which is not being done right now, particularly during winter. We've just had the election, things are a bit slow. They need to keep volumes up. Yeah. So, there's some great opportunities being offered out there. So you need to see what that rate is that you want to aim for. You need to know that you've been paying your loan off on a regular basis and you haven't been in arrears. That's an important one. How long you've been with that institution, and if you've got other products with that institution as well. That's all going to beef up that conversation where you can say, hey, I'm loyal to you, I'm paying this, what are you going to do about it? Now, it's likely that what the lender will do will hang up, and then they call you back because they want to check it all out. They want to throw it through some sort of
some magical
machine that's going to sort of say, spit out an answer. And, this sort of may go on, you may be in negotiations for a while, but ordinarily they're just going to come back and give you something,
So you threaten to walk and go, if you don't match this, I'm gone.
Yeah, well, you can say, but, I think it's important. I think that's a lovely way of saying it, Philip, but I think it's really important to be respectful during the course of the conversation.
Yeah. And I think logical as well. I think the selling point is having done your homework, where you can say, I'm paying this, I see that a comparative product is coming at this price, and I see that you're also offering this to new customers. Let's be reasonable. Yeah, I think that's the key thing. It
is. And as I said, and it's really interesting just to sort of help people understand how you can slip out of that competitive band when it comes to your rate. Lenders got really savvy and really clever with the way that they actually write to you when interest rates go down. And I don't know if you guys have noticed this, but sometimes when you'll get a letter from your lender, it's going to say, the RBA made a decision to reduce the cash rate, and so therefore your new repayment will be X. But they don't tell you how much they've reduced that by.
Yeah, they just give you new repayment.
They're only giving you the new repayment.
So from X to Y, they just
Correct.
say it's this.
Yeah, that's right. And the only way you can find out how much they've actually passed on from that rate cut is to go onto your internet banking, or to call them, or to check out some sort of other documentation you may have had in terms of snail mail. And if you and often you'll find, this happened to me, that it was only 18 basis points passed on, not 25. Well, hang on,
it's a bit cheeky.
Yeah, that's cheeky. I'm not comfortable with that. But again, if you're an investor, you need to keep your finger on the pulse when it comes to your rate, because you will slip out. Because we've also had some of the big banks increasing rates, standard variable rates and investor rates out of cycle. So, we might just accept that that's, a part of life, but it's not. And we really need to be looking at where that competitive band is. You don't have to have the lowest rate. You just have to have one that's in the competitive band and all the other boxes are ticked.
So question, Lisa, so that's highly relevant to those who have loans, be it one, be it multiple right now. For investors that are maybe they maybe bought their first property, they may be looking towards settlement, they may be thinking about going in the market. What would you advise to first-time investors now when it comes to their financing, just in terms of the kind of product they should be looking for, maybe a little bit on whether it's a fixed or a variable rate? So any kind of points you can give new investors to what they should be doing.
Okay, so what's the plan? Mr. New Investor, what is your plan? What's your end game? What are you building here? Are you just going to be buying one investment property, maybe two?
Yep.
Is this going to be a property portfolio that's going to extend, over many years? And if that's the case, then you have to build that portfolio around the product now that product needs to be able to support you through into that. So obviously things to be mindful of is obviously mortgage insurance, which kicks in at 80%. So you want to always have that in the back of your mind when you're understanding what you're doing. And if you're putting two properties onto one mortgage and using the equity in that, you want to be able to have that flexibility that we talked about. So you might be wanting to have a line of credit loan that's going to help you write the check for the next deposit at auction for the next property. You might want to have an offset account because you've got money that you want to park, but you don't want to pay it off the top of the mortgage because once it's reduced, you can't, take it back up, to that level again. So you might want to be using an offset account to help you with that. So you've got to be thinking about all the moving parts that are going to help you reach that end game and how the product needs to be structured now. Particularly also a really important one, what name's it going to be in?
Okay, yeah.
Such an important one. People get this wrong all the time, a lot of people like to buy in trusts.
Yes.
I'm not necessarily a big fan of that, but it just depends again what you're looking to do and how it's going to be structured over time and what the end game is.
Now, something you said to me years ago, I reckon probably 6-7 years ago, and a term that's stuck and resonated is you refer to a mortgage as being an enabler. And it's very rare, I think, for people who are going into taking on hundreds of thousands of dollars of debt, of thinking about it being an enabler. If you could just amplify on that. So just how can taking on big debt for a particular property, how is that an enabler?
Well, it's good debt, isn't it?
Yeah.
It's not what they call bad debt, because it's usually on a property that's going to be appreciating in value, or on something or an asset that's appreciating in value. It's an enabler because it is the tool that allows you to have the freedom and the opportunity to build equity. And because equity is the key to your next investment. So you've really got to have that at top of mind. What am I doing with this property? Well, some people say, that they are investing in property because it gives them tax benefits. I think that's a side. It's like having chips with your, with your steak. It's a side piece, right? The reason why you are in there is really for that main meal, and it's for the growth.
Yeah.
And so if you've paid off your owner-occupier property, and so you have no owner-occupier debt, then you want to be starting to pay off that investment debt, and looking at that combined with natural capital gain to open up equity and open up opportunity, and that's why it's an enabler.
Yeah.
I think I'm going to have to use that as a segue to sign off. We could chat about this forever, but
you think?
Yeah, really, I love the insights, Lisa. Let's get you back.
Yeah, great.
I think we probably should look at mortgages a little bit more. We always like talking about the sexy stories about making lots of money, but the mortgage is the enabler.
It is.
Yeah, what I take from this conversation for our listeners, I'd say learn to love your mortgage.
Yes.
It is an enabler. It does a good thing. In terms of wealth creation, get educated, so know the different mortgage products and what they do and what you need. You need to keep informed. So, every single first Tuesday of every month, the RBA meets and something happens with interest rates. They either go up or down or stay the same. So you need to know what's happening. You need to keep connected. So you need to make sure that you're looking at your statements, understand what your interest rates are and whether or not you're still in that competitive band. And if you're not, do something about it. And we went through those today. So really appreciate the insights, Lisa. Alex, thanks for joining us, mate.
Thanks, Phil. Thanks for having me along.
Very good. Remember to check out smartpropertyinvestment.com.au. Also on Facebook, Twitter, and all the other social channels. You can follow me at Philip Tarrant if you like. You can also follow Lisa
at Lisa Knows Money, all one word.
There you go.
Lisa Knows Money.
Nice one. And you can't follow Alex. I don't think he's on Twitter.
No,
not yet. We'll get him there eventually. Thanks for tuning, everyone. We'll see you next week. Bye-bye.